4, 3, 2, 1, and we're live. Donnie, thank you. Welcome to the show today. It's a pleasure having you here to discuss such an important topic. With the news going crazy, talking about interest rate hikes, interest rates are climbing, rush to the mountains. We need to talk about this. Let's get real. How is this affecting Oklahoma City? Are the home prices on alert? Are sellers going to be in trouble now? How serious is this issue? But first, tell us a little bit about yourself and what you do.
Sure. Well, thanks for having me on the show. My name is Donnie Keim with Valor Bank. For those of you who don't know me, I'm Vice President of Mortgage Lending for Valor Bank. I've been at the bank for 3 years now, and what I do is basically I make sure that our operations is running smoothly. I also originate so that I'm able to do my personal loans, and one of the things that Landon had asked me to come on and talk about interest rates today, that's something that I find an interest in. So I kind of have a backstory that kind of helps share and hopefully relate and share some information to your borrowers or potential clients to kind of help explain what's going on in the market so that we can put their minds at ease, given that we're still at historic lows currently for over the life of mortgages. So.
Sure, that's important to take the perspective, not just this very short window, but the full perspective. Okay, so for those that maybe clicked on this link and are watching this right now are going, oh my gosh, give me the quick answer. So if you're looking for a $200,000 loan right now, is this, how much are they expecting this thing to change?
Sure, so one thing to keep in mind is that for every 0.25% in rate, you're talking about $30 a month. So in the big scheme of things, yes, over 30 years, you might be looking at, hey, that's going to equate to a lot of money. If it's just a matter of monthly payment, maybe there's a few things you tweak in your lifestyle. Maybe it's not going out to eat, or maybe it's not that coffee that you like. But in the big scheme of things, it's really not that much of a move. And most people are on their mortgage for 5 to 7 years anyway, so they don't even see that full effect of a 30-year mortgage. So if you're looking at a 0.5% jump in rate, maybe on a $200,000 loan, you're talking $60 or so on your monthly payment. So yes, it is affecting it, but there's also a lot of different ways that we can look at loan options to help mitigate that increase in rate. Maybe it's getting rid of PMI or some different things to kind of help.
You're talking about the private mortgage insurance.
That's correct. Private mortgage insurance for a conventional loan. A little different with FHA,
sure,
since that won't fall off, but there's definitely some different options that we can always look at there.
So it's important then to look at it in terms of a full picture. I think some folks get in their mind interest rate, but then it's really a little bit more complicated than that. When we've got, like you said, you've got a conventional versus an FHA option. You also have how much you're bringing down. Are you paying the PMI, and how much PMI are you paying, and how long are you paying that? And then how long you're going to be in that house. Like you said, I think the National Association of Realtors is saying anywhere between 5 to 7 years is what the current crowd is staying in their home. I mean, the days where they're going to stay there and pay their 30-year mortgage, this is few and far between. So I think that's a good, healthy look. Well, we're going to go straight to the listener questions. Allison from Norman. Thanks for writing in, Allison. She starts it off saying, "Hi, Landon. We love the show. We currently live in Norman and rent an apartment. Our lease is not up until January. We were going to wait until January to start buying a home, but with interest rates on the rise, should we go ahead and break our lease and get a lower payment?"
So what I would say to that is I would definitely inquire about maybe purchasing sooner. It really just depends on the trade-off between how much it would cost to break that lease, and then also to see kind of what current markets where rates are. Projection. We're already seeing some interest rates in the conventional world over 5%. Some lenders are maybe a little under 5%. It just kind of depends on who you go with. FHA rates are in the mid 4 range. So I would definitely say I would maybe look into doing an inquiry. Typically, with most lenders, your credit is good for 120 days. Some lenders will offer an opportunity to look at even locking in a rate without having even a property picked out. So you can kind of lock and shop it. Typically, you can go out to like maybe 90 days on that. And then it gives you the ability to kind of hedge your bets and protect yourself from a raising rate. But I would say you just have to kind of weigh the options of how much would it cost me to break that lease, as opposed to, hey, what is an extra maybe quarter in rate if I don't close till first of the year look like? So we don't have a crystal ball. We don't know exactly how much how much the move will be in the market for interest rates, but we can at least give you an idea of what you're looking at and give you a projection. There's a lot of things that can impact rates. It's not always economic data. We may have geopolitical issues overseas,
Sure.
or it could be that we have a hurricane or a natural disaster that affects job numbers, kind of like this last time with, but there's a lot of different factors. But I would definitely say, hey, we're kind of in that last quarter of the year. Maybe inquire with your mortgage lender to see, what your options would be.
And also find out what your lease cancellation fee is.
Absolutely.
Some of these are crazy. They make you pay out the complete. Cody from Oklahoma City says, I recently got qualified for a home loan. The news keeps talking about rate hikes. Does that affect me, or am I good because I'm already pre-qualified?
So that's a great question. Just because you're pre-qualified doesn't mean that you're locked into an interest rate. So typically lenders will want to make sure that they have a contract before a lender will, lock in a rate for a certain time period. If you're closing on in 30 days, maybe we look at locking you on a 30-day lock period. That means that typically you're going to get a little bit lower interest rate than locking it out on a 60-day lock interest rate. And what that means is if you lock it for 30 days, as long as you close in those 30 days, then that rate is guaranteed for the term that if you do a 30-year mortgage, that's what's going to be guaranteed. 60 days, as long as you're closing before then you can always extend your rate locks.
But that's once you're under contract.
That's once you're under contract.
Okay.
Now, one of the things that I mentioned earlier in the show was some lenders will allow you the ability to do what they call like a lock and shop or something like that, where you can do a TBD or to be determined address, where you have the ability to lock out your rate on 60 to 90 days without having a property, and it doesn't matter if you change your loan amount or whatever. And so that protects them from raising rates. So
Interesting.
Not all lenders offer that.
I was going to say, that's not something you just go to your regular run-of-the-mill and get.
Sure.
So what does that typically look like? Is that an extra fee they pay up front, or?
There is not. Now, there may be some lenders that do that charge a fee. We do not charge a fee. We can lock it out on 60 to 90-day lock. That a 60-day lock is the mandatory that we have to on a to be determined address. But there's no upfront fee there. And typically on a 60-day lock, you're going to see about the same interest rate as what you're going to see for a 30 or 45-day lock.
Interesting.
So
okay. So it's not. So it's now. This is always the wonder, right? Well, what if interest rates go down while I'm locked? What do I do then?
So typically, lenders will not want to necessarily bust your lock. It's something that we have on our end as pull-through rates with our investors or our servicing companies. So we try to, unless they move substantially, typically you cannot renegotiate your rate lock. If they move a lot, then that's when we typically will look at renegotiating that rate lock. It may not be the absolute bottom rate that you might be able to get, but it could be, let's say rates moved a quarter lower. You might be able to move your rate an eighth lower. It just depends on the scenario. Now, if they moved a lot, obviously we would look at trying to get them the best deal possible. So if that meant that we just had to bust a lockout, then we would look at doing that and fixing that for them. So
And that's something I don't think a lot of the big guys will do. I think, and when I mean big guys, I mean like Wells Fargo, some of these larger institutions where, quite honestly, I've had feedback from buyers that, hey, I feel like a number. When I call, it's like, I'm on hold. I'm talking to 5, 6 different departments and getting transferred over here and waiting on hold there. And they really don't take that personal situation into account, whereas I feel like a regional bank really does, or a local bank is able to do that. So that's interesting. So for Cody's situation, it sounds like if he's really concerned going forward, he needs to inquire about this 30 or 45 or 60-day lock where he can shop and lock and shop. So that's great. Also, from the lender's perspective, if they, just let you get whatever low rate you ever wanted, well, that's not any guarantee for them as well. So it's kind of a two-way street on the lock. That they're kind of committed to that as well.
Sure. So typically when we lock, the borrower's committing to us as a lender, like, hey, look, yes, I am comfortable with that rate. And it protects them in case rates go up. So the lender's taking that risk.
Yep.
And so therefore we kind of expect, kind of the same thing in return. Because, we're hedging our money and we have to pay off, fees and losses if we bust out too many locks. So it is one of those things that, we kind of hope that they will, a borrower will understand that, hey, we're protecting against higher rates, but it also is, you may not be able to get a lower rate if they drop just a little bit. So
you had mentioned something about forecasting loan rates. Can you talk to me a little bit about how you do that on kind of a micro scale here in Oklahoma City? I mean, how are you forecasting to your clients? I mean, I've heard you were telling me stories where you can 30 minutes before a rate change lock some people in before the rate change. I mean, that's wild.
Yeah.
How does that work?
So there are different apps and subscriptions that a lender can maybe subscribe to, where that's all these guys do. They watch the market, mortgage-backed securities, and interest rates aren't necessarily tied to a 10-year treasury, but they tend to follow the 10-year. And so this may get too technical, but I actually subscribe to an app that tells me what is going on in the market as it happens. So typically an investor, with rates changing, we will see rates maybe change an hour after I already get notification that they're going to happen, and that's because the guys that are doing the mortgage-backed security pricing right then, they're kicking that information almost immediately out, so that we kind of know what's going to happen, the next 30 minutes to an hour.
And so then your institution hasn't quite responded quick enough then. Is that kind of where the latency is it's you're locking it in at the local rate, but it's already changed at the national rate? Is that?
So basically what will happen is whenever we get these live updates, we may see a deterioration in the market. So we know, hey, there's a sell-off in the bonds, so that's going to affect interest rates are going to about to go up. Well, typically there's about a 30-minute to an hour lag before all of the national averages get moved over. And so it allows us, if we time it right, to go ahead and get that better pricing before, they change it. So what I tell my loan officers, whenever it's happening, I'll say, hey, rates are about to change. If you have any that you need to lock, let's go ahead and lock them. If they're getting better, I kind of tell them the same thing. Hey, we might wait till this afternoon. There may be a rate change for the better. Now, one of the things that we typically see is a deterioration. They're going to change almost immediately within the hour. A reprice for the better. They typically change it a few hours because they want to see if the market will kind of, settle back down. So we tend to see improvements take a little bit longer than deterioration.
Interesting.
So
yeah. Good stuff. Yeah, so we're going into this game of buying a home and getting the best rate, and it feels like a game, with money on the line too. So having a bank that can really follow that, man, that sounds super important in this process. Also, we've got the down payment, we've got the interest rate figured out, we've locked into it, and now something went wrong in renovations, or the TRR, the repairs get delayed, or maybe the buyer goes on a work assignment. We have to delay that closing date. What happens then when the contract, we now have to move the closing date past where your rate lock is?
Sure. So that's a great question. Every lender is going to be a little bit different in this scenario. If we have to extend your rate lock, sometimes the rate lock extension can be free. Sometimes it will cost a little bit. Every lender is a little different. So, for instance, if it's going to extend and it's not going to be free and you have to extend it 10 days, it may be 20 basis points. So on a $200,000 loan, it may cost $400 to extend that rate lock for that period of time. We try to work with the borrowers as much as we can because we know that some things are just out of their control. Sometimes the seller may say, hey, yes, we understand it was ours, so then maybe they contribute towards maybe more sellers' contributions to closing costs to offset that.
Sure.
But we definitely try to work with the client to kind of limit that cost to them. But just because your rate's going to expire and you have to extend, that doesn't mean you're going to lose your interest rate because rates are now, a quarter or 0.5% higher. We can look at doing an extension to keep that same rate.
Okay, and a question that I don't even understand really how this works. This part of the show, we usually get pretty technical. Most of our listeners that are just here for the market report, they kind of chime out in the first 10 minutes, and then we kind of get a little technical towards the end for the real estate buffs that watch the complete show. So buying down rates, okay? Don't really understand how that works. What is that concept? How does that come together?
Sure. So in any loan scenario, the borrower has the ability to buy down their interest rate, or what they call a discount point. That discount point, now, full disclosure, talk to your CPA. I'm not for sure 100% with these new tax laws that have changed, but in the past they've been tax deductible. So you can actually get a tax deduction off of that, buying that point down. So what buying...
Because it's a fee.
It is. It's a fee.
Yeah.
And so basically what a borrower can do is, let's say the rate today is 4.875. If they wanted to get their rate to 4.75 or 4.625, as a lender, we would tell them, hey, to get to that rate, it may cost 0.25%, meaning at 25 basis points. It could cost 0.5%. Sometimes it costs more than that. It just depends on how low you want to buy that rate down. But it's just a one-time fee at closing. It's a discount point, and then they're locked into that lower rate for the life of that loan. So it allows them to get a little bit lower payment for a small fee. And so what we look at doing is, hey, what is the break even there? How long are you going to be in the house? If it lowers your monthly payment by, $30, and it's $1,000 to buy it down, maybe are you going to be in this long enough to where that savings offsets that cost? And then if so, then if you have the extra money, maybe we do look at buying that down. Is
it the actual investor that gets that money up front, or is it that the originator is getting that discount point up from the start and then selling that getting that lower rate? Or, in other words, who's making that decision of, okay, to give this lower rate, it's going to be this percent? Is it the investor, or is it the originator, or is it both, or how does that work?
That's a great question. So
Sure.
As a lender, we have signed up, and not everybody's like this, but most everybody is signed up with, bigger investors that will buy the servicing, whether it's a Wells Fargo or Flagstar Bank or U.S. Bank or some of these bigger Fannie Freddie directly. And so they give us rate sheets every single day. And as a lender or a bank, we build in our margins of what we need to make to be profitable, to pay our loan officers, to pay our processing.
Right, do the front end.
Exactly.
Keep open.
And
Sure.
so what that does is then that will then determine what, if we're not meeting what we need to make, then basically we'll just have to charge the discount to meet that
the margin.
Minimum. Exactly.
Yeah, the margin difference.
Exactly.
Okay, gotcha. So the investor doesn't really care whether somebody's doing a buy down or not, because they're not even seeing that portion of it. Okay.
Correct. They will not see that until they end up maybe buying that loan to service it or something like that. So
I gotcha.
So, but that is more, the discount point is determined by the actual originator or lender that you're working with.
Gotcha. So that's an important distinction. I always had thought that the investor somehow was getting involved in that part of the game because they were saying, well, we're going to get less money at the end of this loan cycle because of the lower interest rate, so we'd rather just take some quick cash now. But it sounds like it's not that at all. It's you're saying, okay, here's what it costs to get a rate at that, and here's what we're going to be making. We're gonna charge the difference to be able to facilitate that for you. Now, what if somebody is in a credit risk category? Let's say a subprime borrower, and it's like, hey, they got kind of a bad credit score, and they think that I'm just going to come in and pay extra to get that better rate. Does that exist? Do you get that option when you have a low credit score?
Yes, you do. You are the same as someone that has a perfect credit score. Again, I'll just kind of say this: every lender is different. Some lenders will go below 600 credit score. Some will not. On a conventional loan, you're going to see more price adjustments based off of their credit score. It's typically every 20 points in your credit score below 740 on the credit scale. And that's
20 points below 740.
So
we're seeing notches.
Yeah,
happening.
So 740 and above on a conventional loan
would be a prime borrower.
You're going to be a prime borrower. 739 to 720, you're going to get dinged a little bit on the rate. And it doesn't necessarily mean that you're going to get a lower rate than someone at a 740. Again, it just depends on where that bank's margins are. If they're making over or less, their rates may be the same. They may be a little bit worse. But as you go lower, that difference increases. And so that's where we start looking at the different loan programs, because FHA, for most lenders, does not really care if you're a 640 or an 800 credit score. Some lenders, like Valor Bank, we don't have a difference in rate. So on an FHA loan, we don't, not until you start getting a little bit lower, 620, 600, below 600, that maybe you get a little bit worse rate. But we're still seeing some phenomenal rates for even though some of those subprime.
Because it's not always about just credit, right? We get the debt-to-income ratios and all that are playing into the metric. And now, let's say, for example, somebody's been, if they're self-employed versus a W-2 employee, that's always a big question, If it's apples to apples, does the W-2 employee get a better rate than the self-employed? If it's straight across the board, they meet the same qualifications. Do we get different rates for self-employed?
No, it's the same. So when we look at the main factor there is what is their credit score and what is their debt ratio. Now the debt ratio doesn't really affect, or it does not affect, their interest rate. What that would affect is if they have private mortgage insurance on a conventional loan. That's when the debt ratio matters. Gotcha. And the credit score. So there's a lot of different factors with.
Well, I was going to say your debt to income ratio, well, I see what you're saying. Yeah, that's different from the amount of credit you're using on a credit card.
Right.
That ratio would be the amount of debts you have to pay off compared to what you're bringing in each month.
Correct.
So, okay.
But no, they would get the same interest rate. So
interesting.
We don't have a.
So interest rate is determined by credit score. Your mortgage insurance is determined by your debt to income ratio
And credit score.
Yes. Okay.
Now your rates are also dependent on your loan to value. So what that means is if you're buying, it's the difference between what you're actually lending and borrowing versus what you're buying the house at. So if you're putting 5% down, Oddly enough, you're actually going to get one of your better interest rates than if you put down 20%. Now, this is going to blow everybody's mind, and this is one of the things that is the hardest
Warning,
thing
crazy alert.
This is one of the hardest things to explain, but on a conventional loan, and sorry if I'm going into something.
this is the guru section of the show.
So typically, when you have mortgage insurance, the lender looks at that as, hey, yes, there's more risk, but we have this private mortgage insurance to protect us in case of default.
Right.
Because basically what that is an insurance policy to protect against the default. And if it does, it's been underwritten with MI to protect the losses. Whereas at 20% down, you're just out of that threshold to where you're not required to have mortgage insurance.
Right.
So then the lender's like, okay, they're just outside of that. And if they default, then we're a little bit more
instead of insurance,
exposed.
we still have to sell the house.
Right.
Yeah.
So there is actually a break between 80% and 75% down, where it's actually slightly worse rate than if you have mortgage insurance or if you put 25% down, because then the lender is looking at it from there's a little bit more equity in case we have to sell this, so there's less
and
risk.
Insurance.
Yes.
Yeah.
Now, that doesn't always equal a worse rate. That depends on the pricing for the day and how the lender is pricing that loan. So everybody is different.
So how does that work from the lender side when somebody defaults on a loan with mortgage insurance? Is that something you just call them up and you say, hey, he defaulted, I'd like to pay my deductible, and they say, here's your cash.
No, that's a little bit different. We, obviously there's the, foreclosure process and all of that, but those policies that we're paying basically for the MI is something that, is dealt with on the back end, and that's a whole nother story that even I don't really grasp exactly.
I was gonna say, because that's always a wonder is like, oh man, we walk into some houses that are REOs and they are just jacked up. I mean, you got to think, usually when somebody defaults on their payment, something's been happening for a while, okay? And they usually pay their pay. They want the roof over their head first, so they've not paid other things to pay that mortgage payment. And so that often translates to repairs that maybe, they could put off a little longer, like the leaky faucets and the electrical outlets and these kind of things go on and on and on. And then you get maybe the kids are a little rowdy and they kick holes in the walls and they don't get fixed because we don't really have the funds, and you end up with a property that now is worth a lot less than what they bought it. So I could see how the private mortgage insurance is much more beneficial to the bank than just an open guarantee that, you'll get the house back. Yeah, well, we may not want the house back, so it makes perfect sense. Well, you're a busy man. I appreciate you coming by today. You've answered some great questions. Is there anything else we've forgot or anything you want to touch on?
No, I appreciate you letting me come on and share kind of my knowledge and information with you and your listeners. If anybody needs a mortgage, we're happy to talk to them about it, kind of educate them. That's one thing that we like to do at Valor is, hey, even if it's just answering some questions, we're happy to do it. Doesn't necessarily mean you have to use us. Obviously, we'd love for you to work with us.
Sure.
And get you some quotes. And again, with raising rates, look at possibly giving you a rate lock before having that property. But
the lock and shop, that's cool. That is a cool feature.
That is a kind of a game changer with a raising rate environment.
Sure.
And something that we didn't talk on, and I'll mention this: if you have a new construction, we can do an extended rate lock program. Some of them are all the way out 360 days.
When you're building
a house.
Interesting.
And so that's something. Now, typically those are going to have an upfront cost.
Gotcha.
Sometimes it's refundable and it can be credited to you at closing, as long as you close, or sometimes it's non-refundable, meaning that, hey, you're just trying to protect yourself and it's an upfront
Here's what
cost.
the option period costs.
Exactly.
Yeah, sure.
So if you have buyers that are looking for new construction, those are some things to maybe ask your lender. What do you have? What does that look like?
I would think that would be important for both sides in that party. like the interest rate goes up so high that the person doesn't qualify for the loan anymore.
Sure.
And
Yes.
now now the builder's going, yo, I just built this whole house custom
Sure,
for you.
sure.
So I would think that's a win-win for both sides. I mean, in negotiation, if you can say, hey, my buyer is locked in for, 9 months, you're not going to have to worry about the interest rate stopping this deal, Mr. Builder. I think that's big.
Yeah.
Especially for somebody doing custom work. Oh, man. I mean, some of these people make decisions and, I am all for customizing a home, but when you go outside the boundary of what can be bought and sold in the fair market,
Sure.
everybody gets nervous on those transactions. So that's just another layer.
And with those extended rate locks, they would have the ability to do a float down option. So that meaning if rates get better, then they can float that down typically within 60 days of closing on the new house.
Oh, wow.
So, those are some things to take into consideration. And again, not to be necessarily freaked out by these raising interest rates. Again, they're they're still at historic lows.
Historically low.
I looked at an article, 1981, I believe. Interest rates were at 18%.
Wow.
18%.
What's that, like 1940? 1950, somewhere in there?
1981.
1981?
That's what I read. It said 1981.
That's right.
It went from like 8% to 18%.
Holy cow.
And then back down.
That's crazy.
So, there are people in our lifetime that have seen double-digit
Sure.
rate hikes, so anyways.
Wow. Well, Donnie, thanks for coming on. I appreciate your time today.
Absolutely. Thank you.
All right. If you got questions, comments, or concerns, you can email us anytime at landon@okcreal.com, or you can also visit okcrealestateshow.com. There's a listener feedback at the bottom of the website. You can fill out your questions. We'll read them on the air if we can. If not, I will get back to them in email form just as quick as we can. Thanks for watching the show.